Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Mutual funds are one of the best ways to invest in equity markets and grow your wealth. But what is the best time to invest in the market? What does past data and trends suggest regarding the ideal time to put in your money in the markets? Let's understand all of this with Feroz Aziz, Deputy CEO and Rathi Private Wealth. Feroz, good evening and welcome to the show. So, are we timing the market here?
Kavita, yes, more or less, you're not timing, but you're at least trying to decipher if there is some better, relatively little better time to invest. That's what we're trying to see if the data crunching helps us just get the little tad more, if possible.
Right. So let's get the data from your research team. What do you have to say? Maybe if someone is a first-time investor and just with the equity markets, in a year's time, you say that there are specific times when you should, and in fact, if you do, you can really yield the wealth in a longer-term perspective. How many opportunities are we talking about over here in a year?
See, Kavita, one thing which has come out reasonably clearly is that the initial parts of the year are great times to invest. Not scientifically proven, but this is reasonably good evidence. Like you see, January, last 5 Januaries, all of them Nifty has been negative. That's not just a coincidence. If you look at 14 months, 14 times in January, out of the total 23 times Nifty has been negative. But in the latter part, you'll just find about 8 to 9 months out of the total 23 which have been negative. So Jan, Feb, March, and April are relatively great times to invest to get that 0.5%, 1% more. Basically, because April is also a part of that, I think bonuses coming and lump sum investments during those periods when you top up your SIP folios with some additional units which you buy one time could be a good strategy. That's point one. Point two, the age-old myth which has been there in the capital markets is December is a bad month for the markets because the FIIs want to wrap up their show before Christmas. That clearly is exactly the opposite. The maximum number of months of the December is the maximum positive months over the last 22 years where we have seen. But the contrary to the belief that December is a slow month for equity markets.
So, Feroz, these timelines are specifically for those people who want to start their investment journey, or is it even applicable for people who are into regular investing, maybe through an SIP, or they have their schedules on track?
See, I think, Kavita, this is more information to somebody who is a little more seasoned investor because I think efficiency comes in second. First is to begin. Most investors who keep procrastinating and not invest, they should begin to invest. Then you try and see if there were some little efficiencies possible to make it a little better. That's for a graduated investor. So point one, if you're a new investor, you should begin your SIP come what may. Second thing is you have to be patient with your SIP. Markets have this tendency to test your patience. When your patience is least, the probability of making money is the highest. There's enough evidence to give a merit to this case. So if you look at COVID, when all hell had broken loose, most people had given up hope. But the subsequent year, Nifty went up about 70% in FY21. So when all hopes are lost, is when market gives you a springs you a surprise. Like just a couple of months back, whenever I speak into any market participant, they were very pessimistic. And that's when I thought this pessimism actually indicates that the market will go up. And it so did. And we are back to 18,400 kind of levels today. So point is, be patient, start your SIP. If you're a new investor, irrespective, just start. And I don't think it'll disappoint you over the long run.
Going with these observation, Feroz, now if you have to invest in the first 4 months, like say someone has tried putting their money maybe in Jan, by end of the year, how much do you think they could land up earning? Because looking at the observation and the trend analysis, first 4 months are clearly the best months, if I can say, to invest.
A good month to invest because of the market being subdued. That having said, even if in a mid-year, let's assume July, if you get a correction, every time you see falls of 5, 8, 10% in short spans of time, you should always try and empty your bank accounts and move that into equity, irrespective of which month you are in. But 4 months are definitely reasonably good because they've been more negative than positive. So when you accumulate units, when the units are cheaper, is always better. Now, of course, it's a little more courageous decision to do when markets are down. Putting in money requires steel nerves. Please exhibit those steel nerves and the markets will reward you. Having said which, Kavita, if you look at how capital markets or equity markets are little more perceived to be more riskier than they actually are. If you look at these 22 big years of this century, there are only 4 calendar years when the markets have been negative. The 18 other calendar years, markets have been positive. But when you speak to market participants, they think there's a 50% chance of losing money, 50% chance of making money. 81% of the years in this century, calendar year wise, markets have been positive. So, thoda zyada badnaam hai equity market, more than the data throws out.
Right, but then this observation or these trends are also visible on your fund's performance. Do they mirror? Is there any reflection?
See, when you look at fund performance, it's a very diverse universe, Kavita. Quite most of the shows you always say there is a plethora of funds, and those plethora of funds behave very differently. You're so right when you say it's so difficult to choose from 380 active funds. 380 active funds. Take a minute to fathom this number. Those are the number of active funds. If this is the universe, the best and the worst every year have a 30% difference in performance. So it will not be right to say all of them mirror the market. Like last year, the best and the worst fund in these 380 active funds had a 45% performance difference in a single year. In 365 days, the best and the worst had a 45% difference. So there'll be some who do worse off, significantly worse off than the market. There could be some which would do significantly better off from the market. So scheme selection is one skill which people can't ignore and underestimate the power of scheme selection.
I can see there are some fund recommendation also coming from you. These fund recommendation are based on what criteria? The performance?
No, Kavita, see, performance is a very clerical thing to do. You can arrange all the schemes in the descending order of performance and choose them. But that's like chasing your own tail. We have realized and we've done some study to see that funds are very cyclical. They're very cyclical. If they're cyclical, then you can't choose a fund and stay or choose a fund on the basis of past performance. We also had done a study a few years back. Out of the top 10 schemes of the last year, only 2 of them remain top 10 in the next year. So 8 of them slip from the top 10 category. If past performance is not going to be indication of the future, so what should that be? The criteria be? So we do a lot of analysis in terms of some degree of statistical variables are tested using regression model, which is proprietary. We also try and find out what is there in each scheme stock-wise and find out the targets of those portfolios and several other steps of subjective and objective evaluation, which are more forward-looking than backward-looking. On that basis, we choose some schemes which become the model portfolio schemes for that particular year.
All right, so that's the trend analysis that we've discussed, but we also have to move on to our viewer queries now. And if in case you're watching this show live and you too want to ask any query, you can WhatsApp us your query on 865-797-4571. You can also email us your query on themoneyshow@etnow.tv. So that's the place where we keep waiting for your questions. Firoz, we have Deepak online for you. Deepak, hi, good evening.
Good evening, Kavita.
You.
Hello.
Hi, Deepak. I can see you invest in what funds of Canara Robeco and Quant?
Yeah. So I want to just understand whether it is advisable to invest in Canara Robeco AMC or Quant AMC, because what I understand is they are over dependent on certain key people. Like Canara Robeco is over dependent on Sridatta and Quant is over dependent on Sandeep Tandon. So if these key people leave, then are there any people who can manage these AMCs? Because other AMCs like SDFC, ICICI have factory of fund managers, I can say. So they are not dependent on a single fund manager. So that's the query which I have.
All right. And when you say that they are not dependent on any other fund manager or they bank a lot on these two names, how do you decide that, Deepak? Is there a research or do you know people inside the AMC who give you all this information? How do you come to this?
Yeah. So if you see Canara Robeco, there is a lot of churning of fund managers and most of the funds are hence taken over by Sridatta Bandewalkar sir. So that is one thing which I have observed. And quant AMC, as you are aware, it is a completely momentum driven, or what we say, data prediction, and then they decide how to churn the portfolio. So that is something which is, innovated, or something which is a brainchild of Sandeep Tandon. That is what I understand. I think Firoz will be able to highlight more on that.
Sure. Thank you so much, Deepak. Very interesting question. And Firoz, I'm sure you would want to highlight a lot of things. But then I like the kind of observation Deepak has come up with, and there's so much of thrust on people who are running the fund, and the kind of churning and the kind of stock picking that goes into these funds. A layman or an investor who's just new to the world of investment might not observe all these things. But do you agree with Deepak's observations?
Very impressed with Deepak's in-depth getting into the nitty-gritty. It's very important. See, investors can just be lethargic enough and say, nah, yaar, why should I get into who's the fund manager, who's the CIO? But how long does it take? If it's your money, buyer beware is a very, very important concept. So, for Deepak, I'm very, very happy that you're at least going behind whom you've entrusted your money to. Of course, I've met Sridatta and Sandeep Tandon several times in my career. And I firstly, of course, 53,000 crores of assets under management on the equity side is what Canara Robeco manages, which I think is the 11th rank in the country out of the 39 AMCs. They have about 4 fund managers and about 8 analysts. That's the team strength. You're right that there has been some degree of attrition on the fund management level in Canara Robeco, and Sridatta has been a strong pillar for long periods of time. If I'm not wrong, he spent about 7-8 years already as the CIO. And of course, there is dependence when people move in any organization. There's going to be some degree of concern. But I think mutual fund as a platform is a very liquid platform. See, you don't have to. If I was giving money to a private equity guy, I'm locking in monies for 8-10 years, which happens most often than not. Then I'll be really worried that the person whom I cut a check to is no more managing the fund, and I can't do anything about it. Here, if you see that Sridatta leaves, if at all he does, I don't think he is ever looking at his stability there. But if he so did, then you always have the right to exit within a year. Of course, 1 year of exit load periods are there. I think that's a very generous generous time frame in terms of being short. So that's point one. Point two is, of course, Canara Robeco can definitely have more fund managers. For 53,000 crores. Having 4 fund managers is relatively lesser as a proportion of other AMCs. When it comes to quant, of course, Sandeep Tandon is not just the CIO, but also the founder. And it is dependent on Sandeep Tandon, I would say, not from a perspective of daily running, but his treasury mindset. See, most people in the asset management industry come from a fund management standpoint, which is a little lesser courage. But Sandeep Tandon comes from a little treasury mindset, being more mathematical. The models are evolved. There are 3 different criteria on which the models run. One is the risk-adjusted momentum and valuation. All 3 are considered. That's why quant has been able to generate that alpha and been mechanical in terms of surgically changing stocks. See, they had some degree of stocks which went into trouble. Some companies lately went into trouble. They were very, very quick and swift in being out of those stocks. And their agility, along with quant, which is nothing but mathematics, I think I'm very, very positive, and I don't think some founders generally have attrition.
All right. Thank you so much, Deepak, for sending us your query. We have Shreyang God from Bangalore. Hi, Shreyang. Good evening. How are you?
Good evening, ma'am. I'm fine, thank you.
So much for sending us your.
Thank you so much for giving me this opportunity.
We have received your question, and you are maintaining your mother's portfolio, right?
Yes, ma'am.
Okay, we've got the details. Perfect. So you want to exit mid-cap fund, and in place of that, you need some other suggestion.
Yes, ma'am.
Okay, so so there is no need of any regular income from this portfolio, right? Because this is a complete equity-oriented portfolio. Okay, perfect, got it.
Yes.
Firoz.
Yes, so Shreyank, I think if you want to replace a mid-cap fund, then I think you don't have to exit a mid-cap as a universe completely, because the current description of mid-cap is nothing but the 101th to the 250th stock in India as per market cap, free float market cap. That's point one. So that's an important segment. You don't want to miss that out. especially given the fact that you have two index funds which are both Nifty driven, or at least the top 100 driven, and then you have small cap. If you exit mid cap, then you're completely isolating yourself from the 100th to the 250th stock, which is not a great strategy. There's going to be value emerging from there as well. So don't eliminate it. All your four funds will, if you replace a mid cap fund, you will be out of these 150 stocks, which is not a good idea. So I would suggest you enter some degree of flexi cap and other categories which give you some mid cap exposure, if not directly, indirectly. I think SBI large and mid cap could be a good inclusion to one's portfolio. HDFC flexi cap could be a good inclusion. And ICICI approved dividend yield fund could be an inclusion. So don't eliminate mid cap. Definitely, I think that the small cap has more value than mid cap for this financial year. So adding one or two small cap funds like the HDFC small cap Chirag Setalvad fund, along with your Kotak small cap, which is already there, could be a good complementary portfolio on the small cap side.
All right, we move on. We have Mr. Rahul Pawar on phone line with us. Hi, Rahul. Rahul, hi, can you hear me?
Yes, madam.
Okay, so I can see you want suggestions on a small cap fund. That's it?
Yes, madam. Yes.
Okay, do you want to also tell us about your existing funds in the portfolio if you have any?
Current, I have Parak Flexi Cap
Okay.
and Access Large Cap Fund
Okay.
and Quantum Value Fund.
Quantum Value Fund. Okay. So, Feroz, looking at this mix, a specific small cap, should he go for?
I think two small cap funds. Sorry, you're saying something, Rahul?
Small Cap Fund.
Yeah, got that. Feroz.
Great. Kavita, I think from a small cap standpoint, looking at his portfolio, what could be complementary is two small cap funds. We have to be generous in buying the number of small cap funds because each small cap fund has a lot of uniqueness in itself. In the large cap category or flexi cap category, there's a lot of intersection between the stocks of a scheme holds. So in the small cap, the uniqueness is very high. So Aditya Birla small cap, Invesco small cap, and the HDFC small cap. These are the three small cap funds you can consider. In my opinion, Invesco is a relatively small fund, 1,400, 1,500 crore. Aditya Birla Sun Life, past performance, you would not find it so meritorious. But forward looking, I think the fund manager has the potential to generate little extra return over the small cap index. So these are the three small cap funds. You can choose any of them or at least two of them because in small cap, you should not mind having three schemes to divide your money so that there's more diversification given the nature of the small caps having marginally more volatility.
All right. We move on, and next question is from Varsha Gautam. And Varsha says that she's trying to build a portfolio of equity mutual funds and she wants to invest 50,000 per month in 5 different mutual fund schemes for next 15 years. And she wants to know if she can invest in UTI, Nifty, Kotak Emerging Equity, Quant Small Cap, Quant Active. And I think she's talking about Parag Parikh Flexi Cap here. Feroz.
So, Kavita, I think Varsha should, firstly, Varsha, if she invests 50,000 rupees for 15 years at the rate of 14% compounded growth, she would get to about a 3 crore kind of a corpus in 15 years, point one. Point two, I would not buy an index fund, Nifty 50 index fund. I would rather combine active funds together 0.5%, 1% after cost more. So I would not buy a UTI Nifty 50 index or the Parag Parikh Flexi Cap. The other three schemes are good, which you've chosen for yourself. I'll list down some more schemes because you have 50,000 rupees. Don't hesitate to bring your portfolio to up to 8-9 schemes as well if it's 50,000 rupees. HDFC Flexi Cap, ICICI Approved, Focused Equity, SBI Contra, SBI Large and Mid Cap, Franklin India Blue Chip, HDFC Small Cap, and ICICI Approved Dividend Yield Fund. These funds, along with the three you've chosen, will be 10 big funds. So if you put 5,000 rupees each, that will consume your 50,000 baht.
Perfect. We move on. Next question. from Shankar, and Shankar invests in HDFC Retirement Savings Equity, HDFC Small Cap, HDFC Sensex Fund, HDFC Mid Cap Opportunity, HDFC Gold, and he's 33 years old and he wants to continue investing for next 15 to 20 years, and he's asking if he needs to diversify and if there are any changes needed, and he wishes to invest 25,000 per month across these funds. Feroz.
I think, Shankar, you should not buy if you've not already bought all these 5 HDFC funds. Unless you're an HDFC employee, there's no reason for you to be so much skewed towards one particular asset management company. Of course, HDFC is a great asset management company, the second largest asset management company as per assets. I'll give you some other schemes which you can consider. HDFC Flexi Cap is there, which I would buy instead of the HDFC Index Fund. ICICI Pru Focused Equity, the third largest asset management company. SBI Large and Mid Cap, and SBI Contra coming from the largest asset management company. Franklin India Blue Chip, ICICI Pru Dividend Yield Fund. Please don't buy one specific AMC's 5 schemes, HDFC especially, because most of the schemes, they have been following a value principle. So when you see calendar year 2019-20, they underperformed significantly. Beginning 21, when we brought the HDFC Flexi Cap in the model portfolio, because value as a theme was picking up momentum, they did very well. So all the schemes have a little tinge of value in it. So diversification is more material when it comes to similar nature of the schemes, which is what HDFC delivers. So Shankar, please don't buy one AMC schemes, and I've read out several other AMC schemes as well. So diversify, like Kavita said.
All right, and with that, it's a wrap. Thank you so much, Feroz, for being on the show and helping our viewers with their financial portfolio queries. And time to sign off, but I'm going to leave you with our WhatsApp number and email ID where you can send us your queries. WhatsApp number is 865-797-4571 and email ID is themoneyshow@etnow.tv. Thank you so much for watching. Goodbye.